Someone should read the requirement for us, then we try it, we look at economic value added and see how far we can go. Auntie Lodina, are you there? Or who is there? Are you available to take it for us?
Sir, good afternoon.
Yeah, how are you?
Deputy, I'm fine.
Okay, thanks. So take the requirements, then we move on to the question.
Okay, required. Calculate the return on investment and residual income for each division for the year ended 30th November 2026. Ensuring that the basis of the calculation makes it a suitable measure of assessing the divisional manager's performance. B. Explain why you have included or excluded certain items in calculating the return on investment in Part A, stating any assumptions you have made. C. Briefly discuss whether it is appropriate to treat each of the division of Lens Co as investment centers.
All right. So let's take the question itself now and see what we are going to be doing there.
Lens Co manufactures lenses for use by a wide range of commercial customers. The company has two divisions, the photographic division and the optometry division. Each of the division is run by a divisional manager who has overall responsibility for all aspects of running their division, and the divisions are currently treated as investment centers. Each manager, however, has the authorization limit of 15,000 per item for capital expenditure, and any item costing more than this must first be approved by head office. During the year, head office made a decision to sell a large amount of the equipment in Division P and replace it with more technologically advanced equipment. It also decided to close one of the division's old factories in a country deemed to be politically unstable, with the intention of opening a new factory elsewhere in the following year. What division trade with overseas customers, choosing to provide these customers with 60 days credits to encourage sales. Due to the differences in exchange rates between the time of invoicing the customers and receiving the payment 60 days later, exchange gains and losses often occur. The cost of capital for Lens Co is 12% per annum. The following data relates to the year ended 30th November 2006. Sorry. Yeah. So Division P and Division O, their revenue, gains on equipment, direct labor, direct materials, divisional overheads, trading profits, exchange gains, exceptional costs for factory closure, allocated head office costs, net divisional profits. Notes. Depreciation on uncontrollable assets included in divisional overheads are 320 and 460 for each division. We have the non-current asset controlled by the division, non-current asset controlled by head office, inventories, trade receivables, overdrafts, trade payables. To date, managers have always been paid a bonus based on the return on investments achieved by their division. However, the company is considering whether the residual income would be a better method.
All right. Thank you very much. So what are they asking us? They're asking us to calculate the return on investment and residual income for each division for the year ended 30th November 2 such, ensuring that the basis of the calculation makes it what a suitable measure for assessing the divisional managers or performance. They are talking about the issue of controllability principle. So we are going to be determining the profit now. What is the profit that is controlled, or what is the profit that is under the control of the divisional manager? Okay, you take those items that are known, that are not coming in, or that are not resulting as a result of decisions made by the divisional manager. So we take those items, those calls that are not necessary, and they have been captured, we remove them. Those revenue that are not uh and as a result of decisions made by made by divisional manager, we also exclude them. So that's what we are coming to do. Okay, please, you don't have to prepare a new financial statement. The way we did that one the last time, just take their reported profits. Okay, we are adjusting their reported profit. So we take their reported profits. So before you even calculate the return on investment, you need to know the controllable profits for the two divisions. Okay, we need to know the controllable profits for the two divisions. So we have the divisions here. So what are their names? Division P and Division O. So we have division, so we have division P and division O. So we have the currency sign. They are keeping three zeros here. They are keeping three zeros here. So we have the reported profits. So we start with their reported profits that they have there. So reported profits. Okay. So what is the reported profit for the first division?
5250.
Okay.
Okay.
So that is
So that
two,
Five
two,
two five two zero.
okay. Thank you. 2520. Okay. 2520 and 1220. Okay. So we now come and what? Look at what are the items that have been included as revenue and what are the items that have been included as cost, which should not be included. Okay. Someone should give me the first one. What is the first one that's from the statement of profits or loss that we have? What are the items that we think will not come here? One of them is clear. Okay.
The depreciation of the non-controllable asset.
You're even going down. You can see allocated what?
Head office cost.
Yeah, allocated head office cost. Allocated, that is cost is not under control of what? Of the divisional manager. Is the head office that is just giving them apportionment of that cost. So the head office has incurred expenditure, and that expenditure they want to what? They want to share it among the divisions. So they are allocating it. The divisional manager has no say about this one. If the government of Ghana is sharing textbooks, the educational minister has nothing to say. If you ask him the question, you say that this question is appropriate for the government because that particular course or that particular project is not under his control. Okay, so the allocated head office fees cost is not a cost that is under the control of what of the divisional manager. It's a cost that is coming from the head office. So we have the allocated head office cost. Okay, it was taken from our profits. So this is a cost. We have to reverse it. Reversing means that we have to add it to the profit back. So 680 and 1040. 680 and 1040. So we have 680 and 1040. This is a cost we are reversing. It was subtracted from our profits. So we are reversing, we add back. Okay. Now let's now come to this one. Let's now come to direct labor, direct material, divisional overhead. These are the direct labor is direct cost. So if you engage labor, you pay. If you buy material, you pay. So these costs are direct to their operations. Okay, divisional manager, they say see notes below. Okay, so the notes, what are they saying there? Depreciation on uncontrollable assets included in divisional overheads is 320 and 460. These assets, are they controlled by the divisional manager? They say uncontrollable.
No, sir.
Okay, so it means that the depreciation should not be part of the what? The cost that will be subtracted from revenue that they are generating. So we have depreciation of the uncontrollable. Okay, so one is 320 and one is how much? That is also a cost. We add back. So 460, 320 and 460. So we have this one. Okay. So let's go to the question now. I'll mention some of the items. Okay, we have read the top there. So I will mention the items. Then you tell us whether it will be part of it or not. Allocated head office cost. We have done that already. As exceptional cost for factory closure. Is this particular the closure of the factory? Is there a decision made by the divisional manager of O?
No. Sir.
Okay, they have given us information about the during the year, the head office made a decision to sell a large amount of the equipment in Division P and replace it with more technological with advanced equipment. It's also decided to close one one of Division O's was factories in a country deemed to be politically unstable, with the intention of opening a new factory elsewhere in the following year. These are all decisions made by what? Decision as to the closure, decision as to the replacement or the disposal of the asset. They are all decisions made by the head office. We cannot what? We cannot hold the divisional managers of these two divisions accountable for these decisions. They are made by the head office. They are outside their control. So the exceptional closure, this cost is what? Is a cost that is relating to a decision made by the head office. So it should not be taken away from their what? Their revenue. So we come here, we take the exceptional cost also, we add back. So we have the exceptional cost of closure. So you have the exceptional cost of closure. Okay, this division P has none. This one, they have a 1,800. So that will be that will be added back. It's a cost incurred as a result of what? The decisions made by the head office. Okay. Exchange gain or losses. Exchange gain or losses. Okay. The exchange gain or losses, are they okay? Come here. Both divisions trade with overseas customers, choosing to provide this customer with what? 60 days credit to encourage sales. Is it the head office that is making this decision for them?
So
Sir, no, they are making their own decision.
No.
they are making their own
Yeah.
decision.
So the gain and the loss will not be what? Will be subtracted. The gain and the loss will be captured under the profit that we are calculating for the divisional manager. So that one is already done. They have added it. That is fine. Okay, we will not do anything about that one because those decisions, they will make decisions as to people that they are going to be selling to. Okay, let's come to this one. Gain on sale of equipment. Gain on a sale of equipment. The sale of the equipment is a decision made by the divisional manager of P. The sale of the equipment. The sale of the equipment.
The sale
Sale
of the
of
equipment is made by the head office.
is made by the head of it, isn't it? Okay. So
Yes, sir.
any proceeds that will be coming from that sale will not be captured as part of the proceeds that are coming from decisions that are made by the manager. We are looking at responsibility accounting. We can only hold you responsible for what has been given to you. We can only hold you responsible for decisions that you have made. So if you want to determine the profit, you determine the revenues that are being generated under the decisions made by the divisional manager against the costs that have been incurred as a result of decisions that have been made by the divisional manager. Any revenue that are being generated, which is as a result of decisions that are made by the head office, we don't have any question to ask the divisional manager. Any costs that are arising from decisions made by the head office, we don't have any question to ask the divisional manager. We cannot hold the divisional manager responsible. So the gain over here, which was treated as revenue for division P, will be taken away because that is not under the watch of what? Of the divisional manager. So gain on sale of equipment. Gain on sale of equipment. That was revenue. So we reverse it. Reversing means that we subtract. So we go and subtract the 400 here. We have dash. What is the value now, please?
So for division P, we have 3120.
3120. Okay.
And then division O, we have 4520.
4520. Okay. How do we calculate return on investment? It is the controllable profit over the controllable capital employed, isn't it? Controllable
sir.
profit over the controllable capital employed. But this one, are they giving us the capital employed straightforward?
No, sir. We have to determine it.
Okay. We say capital employed over here is calculated as well. What did we say the last time? Capital employed over here is calculated as well.
Total assets minus current liability.
Okay. Total controllable assets minus what? Minus current liabilities.
Current liability.
This should also be all of them should be controllable, since we are measuring the performance of what the divisional manager. Okay, since we are measuring the performance of the divisional manager. So we now come and do this one. The capital employed, we do it for them to one by one. So we come here and have, so I'll have the controllable profits over here. So I have the controllable profits. And I have the capital employed also over here. So the capital employed will be, please remember that I said the capital employed is the shareholders fund plus interest bearing what? Like interest bearing long-term liabilities. I hope you can remember that. Okay. Because I will give you an assignment where there will be a critical issue about this one. So I don't want you to get confused in advance. So we are saying that the capital employed, we are only looking for those capital that are going to be return generated, those capital that they will give us return. We have some liabilities that are not interest bearing. Example is going to be deferred tax. Deferred tax, we're not going to be paying any interest on it. Okay. You can also have free loans from the government or interest-free loans. They are not, although they are loans, but you are not going to be paying any return. So you are not going to be generating any return on the investment by those loan holders. We are talking about return on investment. So those investment that you are making that people are expecting return on it. That's what we call the capital employed. So shareholders are going to be expecting return. The loan holders, they are going to be expecting return if their loans carry interest. Preference shareholders are going to be expecting return. So it is capital employed, which is shareholders fund plus interest bearing long-term liabilities. You have to remember that. I've said it. Okay. If I give you the list, you don't have to uh, do anything. So we have controllable. So we'll be having a controllable non-current assets. What is a controllable non-current asset for each of the divisions? Controllable non-current assets.
For division P, 15,400.
15,400. Okay, so we have 15. Okay. 15,400 here. We have 20 what?
Division O, 700.
Okay, so we now come to the current assets now. We are looking for total assets. So we add the current assets. So we have the non-current asset controlled by head office. That is uncontrollable non-current assets. We cannot ask those people any question about that. So we have inventories and we have the three receivables. So we now add the inventories and three receivables. So we have inventories. Inventories is how much for each of them?
1,800.
1,008 and 3,009.
Okay, 3,900. Okay, receivables is what?
6,200. 6,900.
6,200.
8,900.
8,900. Okay, then we now bring the current liabilities. We have the payables and the overdrafts. Okay. So payables is how much?
5,100.
5,100 or 9?
100.
5,100 and 7,200.
7,000.
We are subtracting, isn't it?
Yes,
So,
please.
so that will be in brackets 7,200. So bank overdraft. Bank overdraft, what are you having?
500 and dash.
Okay, 500 and 0. So what should be the controllable what?
Capital employed. 17,800 for division P. 26,300 division O.
26,300.
Yeah.
Okay. So let's now look at the return on investment for each of them. Return investments is your controllable profits over the controllable capital employed. Capital employed multiplied by 100. So we do it for each of the divisions. So this thing will be, okay, division P, division P, and division O. Okay, division P will be 31. Okay, they are keeping 30, so you pay attention to that one. So we have 31. So let me do this one like this and put it in the brackets like this. So we have, I will do let me do something like this. Sorry. So we have the ROI. So we have 3120 divided by 70,800 multiplied by 100. So we have 4520 divided by 26,300 multiplied by 100. This is what are we getting for each of them?
17.53 division P. Division O. 17.19.
So 17.49. Okay. So this is for the return on investment.
17.1919.
19, okay. So can we say 17.2?
Yes, sir.
Okay. So let's come to their residual income. The residual income, you just write how the residual income is calculated. Residual income is calculated as the controllable profits. So we have the controllable profits. Okay. Net profit before interest and tax. No, it should be tax will be part before interest, but after tax. Sorry. Let me just write this one very simply here. Okay. So just write the residual income. Okay, residual income. So I'll have something like this. So I'll write the RI over here, which is the controllable profits. Controllable profits minus the imputed cost or notional charge. Any name to that one. Okay. Okay. So we have this one. Like, so let's come here. They are controllable. So I'll do column here. Let me do it in a columnar form. So you have division P and division O. Okay. They have 3 zeros at the top, 3 zeros on the top. So we have the controllable profits of 31, 3120 and 4520. So we have their imputed cost, which is the cost of capital. which is the cost of capital. Okay, cost of capital, which is the cost of capital. So cost of capital multiplied by the capital employed. Okay, capital employed. So let's do that and get the answer for them. So 12% multiplied by 17,800. What are we getting?
2136.
2136. So we have 2136. Okay. Okay. 12% on their figure 26,300.
3156.
156.
Okay. 3156. So what is the answer? What is the answer that we are getting?
984 for division P. 136 for division O.
136
for division O.
Okay. Okay. So these are how you do the calculation. So for the controllability, mostly I see they have examined the controllability principle only once, and that was the question that we have solved. Okay, but if you count to ACC and the other stuff, they go with what the controllability principle than any other one. Okay, let's come in. That is the other part that we have done. The B, explain why you have included or excluded certain items in calculating the return on investment in part A, stating any assumptions that you have made. What are they asking us to do over here? What are they asking us to do? The B part. They say you state why you have included or excluded certain items in the calculation. Okay, they are just telling us to explain why the gain on equipment, the gain on sale of equipment, why excluded it. So you state the items, gain on sale of equipment. Okay, we are excluding the gain on the sale of equipment from the revenue or the statement or the profit of division P because this gain is as a result of decisions made by the head office to dispose majority of the worth of division P's worth assets. This decision is outside the control of the worth of the divisional manager, so he cannot be held responsible for that. That is it. That is it. That is it. Okay. If you come to this one, we are excluding depreciation of uncontrollable assets because these are assets controlled under the what? Under these are assets controlled by the head office, or these are asset purchased. These are assets purchased by the head office and transferred to the what? The divisional manager. The purchase of these assets are outside decisions made by what? By the what? By the divisional manager. Therefore, he cannot be held accountable for the anything that is coming from these assets purchased by the head office and given to them. Okay. We also come here the exchange gain and losses. Okay, the exchange gain and losses. The exchange gain and losses. It is what based on the information that we have. It is clear that the sales are being made under the control of the divisional manager. Is the divisional manager? These are autonomous divisions, so they are going to be choosing who they should sell to. So these are sales made by the divisions to the customers under the supervision or under the authority of what of the divisional manager. Therefore, that should be included. Okay. Exceptional cost for factory closure. Okay. The exceptional cost for factory closure is excluded because the decision for the closure of the factory is a decision exclusively made by the what? By the head office. That is fine. We go with that one. Allocated head office cost. Allocated head office cost is a cost that is being incurred by the head office, but allocated on what? On, let's say it can be, they use activity-based costing. They can use any appropriate basis that is allocated using any appropriate basis to work to the various divisions under the head office. So these are costs. So it can be advertising costs. The head office can incur advertising costs for the product that they have launched, and the product is under each of the divisions. So they have incurred a cost. This cost that they have incurred it for the total division. They have incurred it for the total organization as a group. And the group they have division, so they'll just apportion that particular advertising cost to them. That is allocated head office cost. So it's a cost incurred by the head office. But since the head office is made up of divisions, that means that we spread the cost among them. So these are costs that are incurred by the head office that are located to the divisions. These costs are outside the authority of the divisional manager. Therefore, they will not be they will not be included. So you just touch these items. Some of them, the direct labor in this one, you don't have problem. These are direct costs. Okay. So if you carry out operation, you incur them. So direct labor cannot be a cost from the head office. No, they say direct labor. So these costs are directly attributable to the activities that we are undertaking. Okay, so these are direct costs incurred by the division on its own. So this one you can ignore them. But the most important one is going to be those that we have excluded. Okay, gain on sale of equipment, exchange this one, the divisional depreciation on the divisional on the uncontrollable asset, exchange gain or loss, because they have given us some information to back it that this is decisions made by the divisional managers. Exceptional costs, allocated head office costs. These are the things that you explain, why you exclude them and why you include some of them. That is what they're asking you to do. A very simple situation, a very simple situation there. Okay, briefly discuss whether it is appropriate to treat each of the divisions of LENSCO as investment centers. Please, what do we call an investment center? Okay, we have done that the last time. Investment center. What do we call an investment center? What do we call an investment center?
Let me try. The last time you said investment center is one that has the ability to run its own operations, like a strategic business unit, make profit, and also undertake investment opportunities. Yeah.
Okay, and also invest in capital assets. Okay, so that should be investing in capital assets should be very important. So they will incur costs, generate revenue, and most importantly, they also make their own investment decision by acquiring of assets. But let's come here. Let's come here. Let's come to station here. So they will undertake their own investment. What it means is that they will buy their own assets on their own without any recourse to the head office. They will buy their own assets. But for a profit center, the head office buys the asset for them. The head office purchases the asset for them. So they only incur costs, generate revenue, but they cannot make what investment in capital assets on their own. The head office will buy the assets and give it to them. Let's stand there. Each of the divisions is run by a divisional manager who has overall responsibility for all aspects of running their divisions, and the divisions are currently treated as investment center. Each manager, however, has an authorization limit of 15,000 per item for capital expenditure, and any items costing more than this must first be approved by the head office. So based on this information, okay, what is your argument? Can we treat the each of the divisions as investment center, having this limitation on them?
Hello, Senior.
Yeah, same I'm with you.
Yeah. So we can say that if the entity incurs any cost which is above the 15,000 limit, then that the entity will become a profit center instead of the investment center. But then if it is within the limit of the 15,000, then it makes the entity an investment center.
Okay. So right now, okay, that is the point. You make the point for the two and now conclude. So you talk about the two sides first. Okay. Currently, the divisional managers have the authority to make investment. However, they cannot invest in a single item of capital, or they cannot make a capital asset for a single item above what $15,000. So if you want to make any investment there, then they will approve. That particular investment will be approved by what? By the head office. So if the entity or the divisions, if they are very sure that the expenditure limit on capital asset will be within the limits of the 15,000, then we can say that they have the authority to do everything. So they can be treated as investment center. But if their expenditure limits will be above on any item of capital, above 15,000, that means that they don't have authority to make investments now on their own. So they will be treated as a profit center. But they say you should explain why they should be treated as what? As whether it should be treated as what? Investment center or whatever. This is what you do. You make the argument for the two sides. And we have done the arguments now. That is the argument that Senior Kofi has made. But at the end of the day, we have to tell them whether it should be treated as an investment center or it should be treated as what? As it should be treated as investment center or it should be treated as what? Profit center. You have made a point for the two, but you have to now just conclude on one. Okay. Looking at their capital assets, looking at the investments in their capital assets, looking at the investments in their capital assets, can we say that it is what? It is highly possible that their investment in capital assets is going to be above the 15,000 limit. Looking at their capital assets, their controllable assets, can we say that it is highly possible that the investment, the capital expenditure investment is going to be above 15,000?
Yes, sir.
Yeah, so you just say that, okay, looking at the investment in their non-current assets by the divisions, currently their investments in the non-current assets are above what? The 15,000. It is possible, it is highly possible that their capital expenditure on any item will be above the 15,000. Therefore, they should be treated as a profit center. Although you have made a point, but you now use this one to make this particular point. I can also make this point. Okay, this particular 15,400 is not just one item that they are buying, but they are saying the question is now saying that the capital expenditure, it should be one item, any item of capital expenditure. Okay, so they are saying that each manager, however, has an authorization limit of 15,000 per item for capital expenditure. You know, if you go to the assembly, the district assembly, they do form something that we call there's a name given to it. If you go to the procurement section, there's a name given to that particular act. It's something splitting. Okay. There's a name given to it, splitting, where each of the procurement officers, they are given what? They are given limits by the act. So what they do is that if they have realized that they are going to be buying one item which is above the limit, they actually split it. So they can say if it is 10,000 and I can only approve up to 10,000 and you are giving me expenditure up to 15,000, what they will do is that they will now split it 7,500, 7,500. Okay, there's a name given to that particular form. It's an anti avoidance issue when you want to beat the threshold set by the procurement the act for those people. These people can also do it like this because they're saying that the aim the item should be 15,000 per item. So we should spend 15,000 on one item. Okay, if we are going to be buying plants, which is costing 20,000, we can decide we are not going to be buying the item for 20,000 and then pay that amount. We can do it like this. They can decide to do it 5,000. So they'll go and buy the item costing 5,000. Plants costing 5,000. They'll go and buy some 7,000. Then they'll go and buy some 8,000. Okay. You can see that at the end of the day, they have achieved the objective of buying the plants costing 20,000. And you can see that they have beat this particular one. Okay. They have beaten this particular one, the threshold. You can see that the item over here is less than 15,000. So they can also do this splitting, but that should not be an issue. Just base your arguments on their current one. So their investments in current and the non-current assets now are above 15,000. So it is highly possible that an item of capital expenditure will be costing more than 15,000. Then, therefore, it should be appropriate to treat them as profit centers instead of investment centers. Although you have made a point for the two, you explain what investment center and give the point whether they are going to be qualified as investment center and they are going to be qualified as profit center, what our senior has said. Then you now come and just draw a line for that particular decision. Although you can also make a point over here. You are not doing debate. You are not in parliament that you are doing debate. You are writing it down. Just write something there and move on. Okay. You don't have to, you are debating. Who are you debating with? Is it the paper or who? So just put it there and move on. Although they can also do this thing like this. Okay. They can actually avoid the 15,000 by splitting their expenditure. Okay. Although they can do that. But just base your argument on their investment in the current assets and see that is it. The 20,700 that they have over there, it can be that they buy one item and that is costing 20,700. It can also be like they bought so many items that they put together and do that. We don't have enough information to actually what expatiate between those issues. So just use the value. Their investment are now about 15,000. So it is possible that a capital item for them might be costing the 15,000. So they will not be having the authority to approve those expenditure. So it is better, it is more appropriate to treat the investments and the divisions as what profit centers than investment centers. That is a very simple issue. All right. Okay, let me make this point also. I'm saying that in the exam, okay, under normal circumstance, return on investments and residual income, they should always be calculated on opening capital employed, not the closing. But even if you are doing ratio analysis, the return on capital employed is always calculated on the closing balance. No. If you are putting the money in a bank, if you are putting 20,000 in a bank, okay, and at the end of the year, you have gotten an interest of 5,000, okay, this is the return, and the total amount that you are going to be having will be 25,000. If you want to find return on your investment, it will not be 5,000 divided by 25,000. No, your return investment, what is the amount that is giving the return? It is this amount. You are getting the return on the 20,000, not 25,000. But mostly in the exam, the return on capital employed and the residual income, it is mostly calculated on the what? On the closing balance. You can see that the return itself is also part of the closing balance, which should not be the case. It should always be the capital employed at the beginning. So they can give you two capital employed at the beginning and capital employed at the closing place. For whatever you are going to be doing, it is always calculated on the closing balance. Just pick the closing one and move on. Okay, just pick the closing one and move on. Or you can calculate average. You can tell them that it is appropriate to calculate it on average. So you can find average. Okay, the average, you add the two and divided by two. That is it. But it is always calculated on the closing capital employed, which is not appropriate, because this one is not giving us that 5,000 that you're giving to us. The 5,000 has not generated any return to us. We are using 20,000 to generate 5,000. So our return on investment should be 5,000 over the amount that has been invested, not 5,000 over 25,000, which the 5,000 is part of. Okay, but that's what they are going to be doing. So they will give you always pick the closing one. Okay, but if they are giving you two, then you can find average. You can find average that it is appropriate to use average for this calculation than the closing, any of them. Let's use closing. Okay, use closing. Then we move on. All right. Then let's come to the issue of we are going to be expanding. We are going to be expanding the residual income. We are going to be doing information on residual income. The residual income, we can see that we are using accounting profits. You can see that the actual value that we are saying that will be added, the actual value that will be added to the organization. Okay, so the residual income over here, let me use this example. Okay, so let's come here. You can see that after, let's come here. So after we have paid a return to the farm providers, you can see that this, under normal circumstances, they will be getting 2136 as a return from their investment. Okay, so you can see that after taking this particular return, you can see that we are adding additional value of 984 to their return. We are adding additional value of 984 because these returns are for the capital providers. So after settling their return, we are now adding additional value. It's just like your mom has given you a certain amount of money to start business. You have made a profit of 5,000 and you are going to be what? You are going to be, under normal circumstance, you have to pay your mom, let's say 3,000 out of the profit. So you can see that after giving the 3,000 to your mom, you are generating additional 2,000 for her. So you are adding additional 2,000 to her, to her worth or to her value. Okay. So we look at this one. This is additional value that the two divisions are adding to the investment. These are the additional value that they are adding to the investment of the shareholder. This is the actual value that should be generated, but they are generating more than this one. So this is the additional value that they are adding. But this additional value here, okay, it can be misleading. How can it be misleading? This additional value over here is not cash. This profit. Profit is not cash because we use some non-cash items in what? In determining what? Our profits. So this will be misleading. You can be saying that you are adding 984, but in actual sense, the cash that you are adding is 500 because this is profit. The cash value that we have is only 500, not 984. So we want to know what is the actual cash value that you are adding. What is the actual cash value that you are adding to the what? To the funds of the what? Of the capital providers. So we want to remove the what? We want to remove the non-cash elements and now determine the profit in cash form. So what is the profit that we are determining in cash form? Okay, so if we pay this portion of the cash to these people, what is the additional cash that we are generating to them? So we want to know the value in terms of cash, not in profit again, because the profits can be misleading. So we'll be looking at what? A different method, which is an extension of the residual income. It's the same as the residual income, but for that particular one, we don't use accounting profits. This one we are using accounting profits where we are subtracting both cash and non-cash items to get the profits. But that one, we want to know the actual cash, the value that we are adding in cash value. How much are we adding in cash to the value of the what? The capital providers. So we do it in what? In cash profit instead of what? Instead of we do it in cash instead of what? Instead of what? The profit. So we call that one. Some people will call it EVA, or it is what? Economic value what's added. Okay. It is economic value added. So this economic value added, it is the same controllable that we are going to be using, but the profit that we are going to be using over here will be economic profits instead of accounting profits. So the same thing that we are going to be doing, controllable profits, but it will be controllable economic profits. The imputed one too, we'll be using the capital employed. The capital employed that we are going to be using will also be in the form of what? Cash. So there will be some items, there will be some certain items that have been considered in calculating the capital employed, which is maybe they can consider deferred tax and all those issues in what? In computing the capital employed. Okay, because we say the capital employed is just the total assets managed the total current liabilities. So it can happen that deferred tax is even captured in the capital employed. So they will give you information on those one. We just adjust it. We will adjust our profit. Okay, so they will give us the accounting profits, the accounting profit that we are looking for. So they will give us accounting profits. These accounting profits have been gotten by taking into consideration certain non-cash items. So we go and add the non-cash items like depreciation, accounting depreciation. We add non-cash items like provision for doubtful debts. We add non-cash items like impairment of assets, all those non-cash items, we reverse it. We add it back to get a cash because we know that the difference between cash and profit is that is the non-cash items that we are taking for the cash to get a profit. So we adjust this, we adjust the what the accounting profits to now have what economic profits. Okay, so let's come here. So the profit that we are going to be looking at, which is the economic profits, that we are going to be looking at, will now be what we call it the no parts. Okay, net operating profit before, net operating profit after tax, but it should be before interest. Why it should be before interest? Because you consider the capital employed. The capital employed, we are including what? The capital employed, we are including the debt also. So we cannot take the interest for the profit and still calculate the return on the debt because the capital employed that we are using is the shareholders fund, and the debts. And the interest that we are going to be taking over there is also the interest for the debt. So we cannot take the interest over from the profit and still be calculating and still be taking the interest from this one. Okay, so we are just calculating this one to know the imputed cost. The imputed cost is the dividend that we are going to be paying to the shareholders and the interest that we are paying on the debt. If the interest is taken from the profit before we have this no part, and you are taking the interest again, it means that you are charging the interest 2 times. You are subtracting the interest 2 times because the interest has already been subtracted to get a profit, and you are including the interest as part of the imputed cost again. You are subtracting the interest 2 times. So we don't subtract interest, we add back the interest because the interest is part of the imputed cost that will be taken away from the profits. But the interest mostly we do since debt is tax deductible. Since debt is tax deductible, we do after tax interest. We add after tax interest because the interest that we are going to be having over here too will be after tax interest. So we look at how we adjust these items. Let me just share the slides with you. Then we look at it. We have the economic profit. So the
Hello,
calculation
sir.
is like, yes, please.
Please, if you say debt is tax deductible, what do you mean by that, please?
So yeah, are you doing only management accounting and
Yes,
you
please.
are doing only management accounting as
Yes,
well
please.
as
Yes,
oh,
please.
okay. So it means that you did your financial reporting and those things at different places, or you are here to do them.
Yeah, I did it somewhere.
Oh, okay, okay, okay.
Yeah.
Okay. No, it's Ghana, so you have learned and you have forgotten. So I won't blame you, Sina. So don't worry. So if you say it's tax deductible, okay, if you are preparing your statement of profit or loss, before you bring tax, you always bring interest. You always subtract interest from the profit before you subtract the tax from the profit after interest, isn't it?
Yeah.
Okay. What we mean if we say it's tax deductible means that the tax authority will allow you to subtract it from the profit before they will charge tax on the net figure. So you are enjoying
Oh,
some
okay.
tax benefits on it. Okay, so
Okay.
you'll be
Okay.
enjoying
Yeah.
tax benefits on it. That's what we call it. It's tax deductible. But this is a
Okay.
taxable. It means that you cannot enjoy tax benefits on it. So the
Sure. Sure.
dividends are tax issues like that. Okay, so don't worry. I hope we can move on now.
Yes, please. We can. It's clear now.
Okay. Okay. So we have the no parts. We're going to be looking at how we call the no parts. Then minus the imputed cost. How do we calculate the imputed cost? We use weighted average cost of capital. Very important. Multiply by the capital employed. So those of you doing financial management, this will not be a problem. But we try how we can do this one. So how do we adjust the no parts? Okay. The no part is economic profits. So how do we? So adjustment of accounting profit to have the no part. So we'll be looking at that one. Adjustment of accounting profit. So they will give you accounting profit. You will now adjust it with the cash and non-cash items. We are looking for economic issues. So there will be you have the accounting profits. Okay. So you'll be given accounting profit. This accounting profit we are looking for economic profit, which is cash profit. Okay, you have taken some accounting depreciation from the profit. So you add back the depreciation, you add back the provision for doubtful debt, you add back deferred tax issues because the deferred tax is not tax that we are paying. So deferred tax is also non-cash item. We use the actual tax paid. So they can give you some issue about deferred tax. The deferred tax is not cash, it's not tax that we are paying. We are only looking for the tax that has been paid. So you add back your accounting depreciation to this one. So you add back accounting depreciation. So add accounting depreciation, which is non-cash item. Let me just say add non-cash items, which is going to be including the depreciation, the provision for doubtful debts, the provision for deferred tax, and all those things, because all those figures have been taken from the profits before we have the accounting profits. We are looking for cash profits. So all those non-cash items must be added back. How you do cash flow? You add those non-cash items back. Okay. Then the interest that we also add the interest back, but the interest will be after tax interest. Okay, after tax interest. So what is after tax interest? We will just, if the tax rate is 25%, it means that we are going to be enjoying some tax benefits of 25% on it. Okay. Or the cost of capital over here. Okay. The cost of capital over here. The cost of debt over here is after tax cost of debt. So we also find after tax interest. The interest that will be taken away over here is after tax interest. So it means that we also have to include after tax interest. So if the tax rate is 25%, it means that the you are going to be enjoying the amount that you're supposed to pay is 75. So it's 75 that you are going to be calculating here as a imputed cost. Just add the 75 to the profit before you subtract it from the imputed cost. It's already part of the imputed cost. So if you want to calculate your after tax interest, it's just 1 minus the tax rate multiplied by the interest. So if the tax rate is 75, after tax figure will be 75% of the interest given to you. Then you add it back to your economic profit because it has been taken away from the economic profit after tax. So you add the interest. Okay, non-cash items. I've spoken about the non-cash items. It can be provision for deferred tax. It can be depreciation, which is accounting depreciation. It can be uh, provision for doubtful debts. We add that one to back. Another one also we have is sometimes we do investments. We do investments in tangible assets. Intangible assets like research and development expenditure. Okay, research and development expenditure. Research and development expenditure, what they are going to be telling you is that they will tell you that the entity has incurred a research and development expenditure of 60 million. This research, this development has started to generate what cash flows to the entity from this particular date. If this is a development expenditure under, okay, let me borrow something small, under IS 38, since it is going to be economically feasible, the entity will amortize the cost now over the what? Over the useful life of the project. But what they will tell you that the entity has written off all the costs against their profit. So instead of them capitalizing these costs and amortizing it over 5 years, okay, instead of them capitalizing these costs and amortizing it over 5 years, they are written all of them to the profit or loss. So you will not come and ask yourself, this is the amount that we have spent, this is the cash that we have spent. How much of the cash that we have spent are we using every year? So this will be 60 over 5, and that will give you 12. So if they have done first year alone, it means that only 12 million of this should be taken away from our profit, but they have taken 60. So it means that you have to add the 48 back. 48 has been taken in excess. So you go and add investments in intangible assets like development expenditure and those ones. They will give you information on that, please. I don't want to waste this one. Let me just pick some of them very fast, then I will explain with the with the with the examples and the figures, then we see what we can do. Okay, so we are going to be seeing if we can do 2 questions on that one. Okay, so let's come to where are you economic value added. Okay. Okay, so let me come here, economic. All right, so this is the economic value added tax. I've explained that already. I can ask you for benefit. Please look to the benefit. Okay, so this is calculated as the no part net of profit after tax, but it should be before interest. So we have the capital employed is the equity plus long-term debts at the beginning of the period. So we always use capital employed at the beginning. We use capital employed at the beginning for the EVA, which I have explained that it should be the piece. But for return on investment, those ones they mostly use what they mostly use the closing one. But for EVA, we use the capital employed at the beginning. Okay, so the no part, we are going to be looking at that. How do we adjust the no part? The operating cost, the operating profit before after tax is calculated by making adjustment to the accounting profit in order to arrive at an estimated economic profit, which is the cash profit that we are looking for. No part is similar to free cash flow and it's an estimate of economic profit before deducting costs for the capital employed. The calculation of no part requires a number of different adjustments to the figure for accounting profit. So I've spoken about the interest already. In calculating the no part, interest cost of debt, capital should not be deducted from profit. This is because debt is included in the capital employed. I hope I've said that. I hope I've said this one from the beginning. Okay. The
Yes.
interest cost of the debt should not be deducted from the profit. This is because the debt capital is included in the capital employed. So if you do it, if you subtract and subtract again, you are doing this one double counting. Okay. No part should be the profit before deducting interest, but after deducting tax. I've said that. There's a tax relief on the interest. So to reach a figure for no part, the amount of interest charges in the period, less relief on the interest cost should be added back to the figure for profit after tax. Okay, so no part will not be adjusted like this. We have profit after tax plus the interest cost less the tax relief. That is what I've told you, that if the tax rate is 25%, your after tax interest is 75% of the interest. So that is the less tax relief that they are talking about. We have depreciation. Depreciation should be added back. We use accounting depreciation. We use economic depreciation, not accounting depreciation. I will explain what we mean by economic depreciation. Okay. Depreciation non-cash expenses should not be deducted from profits. The main item of non-cash expense is usually depreciation of non-current asset. However, there should be a charge for non-current asset to allow for the economic consumption of value that occurs when the assets are used. So if you want to adjust that one, you have your profit after tax plus post-tax interest. We have adjusted the interest already. Then we now what? We now add accounting depreciation back and subtract economic depreciation. What do we mean by accounting depreciation? And what do we mean by economic depreciation? Okay, accounting depreciation is just calculated based on estimates. So although we are buying the asset, it's a cost that we are incurring. Okay, although we are buying the asset, it's a cost that we are incurring. So we are buying the asset for, let's see, 20,000, and we are expecting to use it for, let's say, 8 years. Okay. In economic terms, this is what we mean by economic depreciation. We are going to be using the asset to produce. The asset will wear and tear. So we are looking for what is the economic value of the asset that has been used for this year. But we are spreading this cost over 8 years. So you will now estimate. Okay. We will now estimate this one, which we call the economic depreciation. The economic depreciation will also allow for the wear and tear of this one, but this will not be calculated on estimate of the what of the accountants. So we will now say like this. Okay, the asset over the 8 years, this is how they will produce. So they will produce 2,000 units, and in the second year they will produce 3,000 units. Okay, in the third year they will produce 4,000 units. Okay, so our depreciation now will now be calculated on the consumption, on the production of the asset, instead of us only what spreading the 20,000 over 8 years. You can see that the value of the asset that you are going to be using in first year is going to be lower than the one that you are going to be using, because you are producing 3,000 over a year and you are producing 2,000 over a year. You can't say the 2 years you are going to be using the same cost to produce 2,000 and 3,000. But that's what you are doing under the accounting profit, 20,000 over 8. Every year you say that production will be the same. No, we are going to be estimating the value of the asset that has been used, which is the cost. This is the cost that we are paying. So what is the cash value of the 20,000 that has been used in the first year? That is what we are going to be using now to take away from our cash profit. Okay. The value of the asset, the depreciation is what? It's cash. You can see that is the value of the asset that we are buying, that we are spreading, but we have already paid for that particular cost of the asset already. So subsequently, we are not paying any cash. That is what we call it non-cash item. So we will now estimate the wear and tear based on the production, or based on whatever method or whatever estimate that is deemed what fits. So we will now be subtracting economic depreciation instead of accounting depreciation. So we add accounting depreciation that will be given to you, and we subtract economic depreciation now. Economic depreciation is now telling us the cash portion of the asset that has been used, the economic value of the asset that has been used in producing whatever we have produced to sell. Okay. However, if the economic profit, if the economic depreciation and the accounting depreciation are the same. It is going to be having zero effect, so we don't do anything. Because if you add, you'll be subtracting the same figure, so you just ignore it. Okay, so they can give you economic depreciation and accounting depreciation. You add back the accounting depreciation, then you now subtract. So I will now write less what? Less economic depreciation here. So you less the economic depreciation. The economic depreciation will now give us the economic value of the assets that has been used. So we have something like this. We have something like this. Shit. We have something like this. Then I'll take this one. Okay. So I've spoken about the intangible assets already also. Okay. So let me talk about this one. We have done a depreciation. Okay. If it can be assumed that accounting depreciation charges are similar to the loss of economic value in non-current asset, the two items cancel out. Okay. Other non-cash expenses should also be added back in order to measure the NOPAT. This will include provision for irrecoverable debts and other provisions. Other provisions. It can be impairments. It can be provision for what? Deferred tax. Those are not in cash terms. We add them back. Okay. Investment in intangible assets. Investment in intangible items include spending on promotional activities, investing in brand, research and development, spending on employee training to increase the economic value of the workforce. In conventional accounting, these items are usually written off. These items of expense are usually written off as expenses in the year that they occur. However, they are items of discretionary spending by management that add to the value of the business. So what they are trying to tell you is that the question will tell you that the training course and the advertising and all those things that have been done, they will give you that this will give the entity, this will give the entity what? A benefit of 4 years. So it means that you have to spread the cost over 4 years. So you don't have to write the cost as an item, the full amount as an item to profit or loss. You have to now spread the cost over the 4 years. So you have to determine the value that should be taken to the profit or loss and the one that has been taken there in excess. You go and reverse that one. Okay, that is what we do to get that particular one. So these are adjustments to these just are adjustment to the low part. Very simple adjustments. Very simple adjustments. Very simple adjustments. Okay. Let me come to the capital employed. So the chart for the capital. EVA is no part more, it's a chart to present the cost of capital employed. There are two elements to the capital chart, the value of the company asset and the cost of capital. So we are going to be looking at the capital employed. We see that we always use the capital employed at the beginning of the year, which can be calculated as what? As the net book value of the non-current assets plus what? Plus the net current assets at the beginning. Okay. Or they can tell you that this should be calculated as market value. They might give you the market value. Okay, they will give you the market value. They can ask you that this thing is calculated on market value, and they will give you information how to calculate the market value. The valuation of the capital employed should be based on economic values of the capital employed. In most cases, this means that our current assets should be valued close to their current value rather than at value based on historical cost. A simplified system for measuring the economic value of a company's capital employed. The starting point is the book value of the company asset. This is the book value of the non-current asset at the beginning of the year, plus the book value of net current asset at the beginning of the year. So adjustments should then be made for this particular one. Let's just come here. Okay, let me just come here. We are saying that I've said this one. They will tell you that the capital employed should be calculated on market value, and they will give you information on how you are going to be calculating the market value. They can tell you the market value is what? Is the market value or the book value of the asset, or 20% of the book value, or the market value is 20% more than the book value of the asset. So it means that for you to find the market value, you find 20% on the book value of the capital employed plus what? Plus the book value itself. You just increase the book value by 20% to have the market value. They can give you any information on that. Now, what is going to happen in this one? Okay, what is going to happen to the capital employed, which is a very important issue, is this. Okay, so the capital employed is going to be this. Okay, So let's come to the capital employed now. Okay, we know the capital employed calculation already. So there will be some serious issue that we are going to be doing here. Okay, please just pay attention here. We are using capital employed at the beginning of the year. We are using capital employed at the beginning of the year. Okay, so if you are using capital employed, there can be a situation where there will be what? There will be additional investment in capital employed during the year. These are going to be increasing our capital employed. Let's come here. Okay, let's assume that our capital employed at the beginning of the year was 250,000. And they are saying that during the year, the company has now engaged in what? The company has now incurred what? Or the company has now leased out an asset. Okay, the company has now leased out, or the company has leased an asset from what? From a different company. Okay, this particular lease, the asset that we are going to be using is going to be generating benefits, and the lease we are going to be paying interest on it. So what will happen is that the lease will also be addition to the capital employed because the lease is not coming at the end of the year; it's coming during the year. So part of the profit that have been generated, part of it will be going for the interest that we are paying on the lease. So the lease will also be part of the capital employed, which we charge the interest that will be paid to the what? To the lessor. Okay, that will be paid to the lessor from the capital. So we always add lease over here, which will be a right of use of this one. So this will be increasing this one. The lease will be additional investment in the capital employed. So if you are doing the lease from March to December, you are going to be paying interest on the lease for 9 months. And that interest is what is a return on the lease. So that will also be a form of what? Cost of capital, because we are paying a return to somebody. So that will also be captured in the imputed cost because it's also a return that will also be captured. So that lease that you are having, that you are paying the interest on, that value should also be part of your capital employed. Okay, so what will happen over here is that the capital employed at the beginning we add what we call, let's come here, we add non-operating leases. Okay, you can see that operating leases are not capitalized. Operating leases are not capitalized. So this is what we do. Okay, this is what we do. Let me bring something to you over here. So capital employed at the beginning. Okay, so let me write beginning here. Okay, so this is what we do for capital employed. Okay, so you'll be having operating leases. The operating leases are all balance sheet items. You have the assets, all right, but these are not going to be recognized as a right of use. But at the date of estimating the capital employed, we now change the operating lease to what? To finance lease. We now determine the what? The present value of the lease liability at the same time the right of use, which you are going to be paying interest on it. So if you are paying the lease 50,000 every year, okay, we now use our cost of capital to find the present value of all the amount that we are going to be paying. So we now change the lease. Okay, the asset is going to be giving us benefits. So we now change the lease as if it is what? It's a finance lease, and we determine the lease liability and also the right of use at the date of the lease. So that will now be turned to finance lease instead of what? Operating lease. So the rentals that we have paid, yes, the rental we have paid the rentals already, so that has already been charged. But we are just changing the what? The remaining rentals now to what? To liability and also rights of use, which we are going to be paying what? Interest on it at the end of every year. Why are we paying 5,000 or 50,000 at the end of every year? Because we are holding the money, that's why we are paying. So the person is not just charging you 5,000, the person is charging you the cash amount that you should have paid today, plus the reason or the time value of money, because you are keeping the money for some time. So the person is charging the interest for holding that money. So we change the non-operating leases to what? To a finance lease, and it will give you information on that one. So you just come and add it to the capital employed. It's a form of debt where we are going to be paying interest on it now. Okay. You also have other non-cash items. But non-cash items, these are the non-cash items will have effect on our capital employed. Okay, let's come here. If we have provision for doubtful debts, if we have provision for doubtful if you have provision for doubtful debts, let's say we are doing 2021 and 2022. Okay, and it's 50 million and 60 million here. Okay, it's 60 million and 50 million here. Okay, let's come here. We know that the capital employed for 2021 will become what? The capital employed for what? For 2022 when we are doing EVA. Do you agree? The capital employed, the closing capital employed for 2021 will become opening capital employed for this one when we are doing EVA. Do you agree?
Yes, yes, senior.
Okay. You can see that the closing capital for this one, you can see that the provision for doubtful debt has been subtracted from our assets before we get the capital employed. Do you agree?
Yes, senior.
Okay. So what is the effect of this provision for doubtful debt on the capital employed for this year? It has reduced it by 50, isn't it? Provision for doubtful debt will be taken away from receivables, and we are having net current assets plus what? Total current asset. That's the capital employed. But the receivables that we are using for this year, that's not the actual receivables. We have taken a non-cash item of 50 from it. So this reduction that is having in the what? In the capital employed for this year, which is the closing balance, will come here. You consider the capital employed for this year, if it is 230, that has been reduced by what? The receivables should have been 50 plus the actual receivables, but we are subtracting 50 from the assets. This is reducing our assets. Since this is reducing our assets, our capital employed will also be reducing. So if you come to the next year, which is 2022, you consider the capital employed that you are using for the 2022, which is the capital employed for 2021 to 2022, it has been reduced by non-cash item. So if you come to this place, you do your 230 plus the 50 now. Okay, because this particular 50, which is the provision for doubtful debt, reduces our cash, our capital employed in the in the previous year that we are using now. So we adjust it. So the non-cash items mostly have more non-cash items from previous years has effect on the what? On the non on the capital employed for the current year. So if we have provision for doubtful debt from last year, the provision for doubtful debt from last year reduces what? Reduces our capital employed that we are using this year. But the capital employed should be economic one. So there should not be any non-cash item affecting it. So we go and add non-cash items from the previous year to the capital employed for this year. The same thing applies to depreciation. The same thing applies to depreciation. How would the depreciation be affecting this? Okay, let me use actual figures over here. Then we actually demonstrate this issue here. Okay, I'm sure if I use this example, everything will be fine now. Okay, let's come here. So I will have 20. I'll have non-current asset as total here. Okay, non-current assets as total here. So let's have 2021. I have 2021. I have 2022 here. Okay, so I have, let's see, this is 200 million. This will be 250 million. So I have net current assets. Okay, net current assets. Let's say we have 50. Okay, then we have 200 here. Okay, then let's have current liabilities here. Current liabilities 50, 60. What will be our capital employed for the 2 years? This will be 300. Is that right?
Yes.
Okay, and this will be 390. Is that also correct?
Yes, please.
Okay, let's not come here. They are telling us that provision for doubtful debts. Provision for doubtful debts for this year was 25, and this year was, let's say, 35. Okay, if we are calculating capital employed for 2022, if we are calculating EVA for 2022, we'll be using the capital employed for 2021. Do you agree? Because we are using capital employed at the beginning. So the closing for 2021 will become opening for 2022. Okay, but let's come here. What is the effect of provision for doubtful debt on our current assets? Is it increasing it or reducing it?
Reducing.
Reducing
Okay.
it.
But in this particular item, we are looking for economic capital employed, which is cash value of the capital employed. The provision for doubtful debt, is it a cash item?
No, it's not a cash
No.
item.
It's a no
So it
capital
means
income.
it means that our current asset, our economic current asset should have been 150 multiplied by 25. Is that correct?
Multiply or plus.
It's plus 25.
Yes.
Okay.
Yes.
And this will give us 325, isn't it?
Yes, senior.
Okay. And this will become the opening capital employed for
20.
2022, which we are going to be using. But we are having 300 over here. We are having 300 over here. What it means is that the capital employed that we are having, we are going to be using for the what? The 2022 has been reduced by a non-cash item of 25. So the capital employed should have been 325. So what we do over here is that we come and add the 25 over here. We come and add the 25 over here to the 300 and now have economic value because 25 has reduced our current asset. Our current asset should have been the figure that we have plus the 25, but the 25 has been taken. So it means that the capital employed has also been reduced by 25. So this will now be having effect on 2022. Why? Because 2021, we are using 2020 figure. So this is not for 2021. This will not affect. This is a closing balance. We are not using closing capital employed. We are using opening. So this figure has been subtracted from the closing capital employed of 2021, not 2020 figure. Because 2021, we are using 2020 figure to calculate the EVA for 2021. So this will be having effect on the following year because we are going to be using this year's capital employed in that year. So the non-cash items, mostly non-cash items from the previous year, will have effect on the what? On the following year capital employed because they have been subtracted from the capital employed that we are using for the what? For the current year now. So we add it. The same thing applies to provision for deferred tax. The same thing applies to provision for depreciation. So the depreciation, how this is how we go about it. Assuming the question is giving you as depreciation, accounting depreciation of the question is giving you accounting depreciation of let's say 50 and what and 70 here. Okay, it means that the depreciation, this is the carrying value. It means that we have taken the depreciation from this figure. Now we are having what? We are having 200. The depreciation is taken from the closing figure, not opening figure. So for 2021, capital employed will be calculated using capital employed from 2020. So this information are not going to be affecting 2021 unless we have these non-cash items from 2019, which are going to be affecting what? The 2020 figure. Okay, so we come here, we come to this 15 million. It means that depreciation has been taken away and depreciation has been taken away. The question can give you economic depreciation. The question can give you economic depreciation. Okay, so let's come here. If you count the capital employed, if you count the capital employed for 2022, I'll do this for only 2022, you'll see something. So capital employed for 2022, okay, will be the 300 that we have from the books plus 25. Okay, what do you think will be the effect? What will be the effect of the depreciation on the capital employed? Is it going to be reducing it or increasing it? No, for 2021, it was reducing. So what will be the effect in 2022? What will be the effect on depreciation? The depreciation has been taken away from this figure. Okay, so the depreciation is not cash item. So we should have had 200 plus 50 because we are looking for economic capital employed. Depreciation is a non-cash item. So that should not be taken away from our asset before we have 200. So this is reducing our capital employed. So you come and add the depreciation over here. Okay, but the economic depreciation should have been 40. The actual depreciation that should have been taken away should have been 40 or let's say 50 over here. So in actual sense, you should have taken a depreciation of 40 over here, but you have taken 50. So since you are adding the 50 back, you have to come and subtract the 40. So you come and take the economic depreciation from the what? From the following year figure. Because we're supposed to have 250 here and subtract what? Only 40 and have 210. But you have subtracted 50 and you're having 200. So it means that you have reduced your capital employed by a non-cash item of 50. So what is our economic value of the capital employed? You add a non-cash item to the capital employed. This will be for the following year, 2022. Then what is the figure that is supposed to subtract from last year? It is 40. Then you now subtract it. Okay, so the non-cash items will have effects on the what? Non-cash items from the previous year will only affect, will only increase or reduce the what? The the current year. So 2021 items will affect 2022. The same thing applies to provision for deferred tax because these figures are subtracted from the closing figures. They are not going to be having any effect on the opening figure for that year because we are taking it. This is a statement of financial position which is prepared for the year at the end of the year. So they are being subtracted from the end of the year figure. So at the beginning of the year, it has no effect, but it will be having effect on the what? On the next year, because we are going to be using the figure that we have gotten over here in the next year calculation of the EVA. So non-cash items will be having effect from the previous year. They will be having effect on the current year amounts, which we are going to be adding. So provision for doubtful debts, depreciation, accounting depreciation, uh, provision for deferred tax and other issues, they also be having the same effects. The same thing applies to what? Applies to investments in tangible assets. The same thing applies to investments in tangible assets. Let me look at this one. Okay. Assuming during the year we have undertaken expenditure, during this year we have undertaken expenditure of 60 million. We have written all of them to profit or loss, but this expenditure will give us 5 years. Okay. This expenditure will give us 5 years. So what it means is that we have to amortize this now 60 over 5. We'll be having 12 million every year. Okay. It means that we have to now capitalize the remaining 48 million. Do you agree?
Yes, senior.
Okay. This 48 million, this 48 million. Okay, if we are doing this in 2021, will this 48 million be shown at the beginning of 2021 or at the end of 2021?
At the end,
At the end. Okay. So would this particular 48 affect the capital employed for 2021 if we are calculating EVA? Will it affect the capital employed for 2021?
No, please.
No,
No, please. Because we are using 2020, isn't it?
yes.
Yeah.
Okay. But would this particular 48 million affect the capital employed for 2022?
Yes, please.
yes.
Yes, please, because this has not been capitalized. We write all of them to profit or loss. So you come to 2021 figure, you add 48. You should have added 48 to your assets, but you haven't added that one. So in the next year to be affecting. So the investment in intangible assets also, they are accumulated figures. They are unamortized figures. Their remaining figures will always affect the subsequent year's figures. Okay, the only thing that will affect the item for that particular year is mostly the non-operating expenses. Apart from this one, the non-cash items and other items, they'll be having effects on the subsequent ones if they happen this year. But if this should happen in 2019, then it means that we are using 2019 figure in 20. If this should happen in 2020, sorry, 2020, then it means that we're using 2020 figure for 2021. So it will be affecting it. So we adjust it. So we look at the effect of that on our capital employed. So investments in tangible assets, I've explained that. Provisions and allowances, I've explained that. Off balance sheet and operational items. Some items will not appear in the balance sheet, and I will use what? The operating leases. At the date of this one, we now change the operating lease to what? To finance lease. And this is not happening at the end of the year. You are not taking the lease at the end of the year. The lease will be taken during the year. So you are going to be paying return on it. That's why we are adding the what? The operating leases to that particular item. How do we calculate the cost of capital? The cost of capital is calculated as we know how to calculate cost of capital, but I will show you that one again. Okay. the cost of capital, we always use the target what? We always use the target debt structure. So the question will be giving you something like, okay, the target capital structure of the entity is this one. We base it on it. Okay. So if the current debt structure of the company is close to the long-term target debt structure of the company, weighted average cost of capital can be calculated from the current value of equity and debt capital. However, if the debt capital structure is different from the current capital structure, you will calculate using the target proportion of equity and debt. The cost of capital and the cost of debt can vary 1 year to the next one. A new WACC may therefore be calculated each year with appropriate cost for equity and debt in each year. What do we call the WACC? Okay. WACC, we calculate WACC when the entity source of finance, is what? Is more than one. So if the entity is using only equity to finance its operations, we only calculate cost of equity, financial management people. So if we are using only debt, we calculate cost of debt. But the entity can be using a mixture of debts, equity, and maybe preference shares, which means that the return that you are going to be getting, the return will be different. Equity shares will be getting a different return with a different percentage rate. Okay. The debt people, debentures or loan people will be getting a different interest, a different return with a different interest rate. Okay. And the debenture, the preference shareholders will also be getting a different interest with a different percentage. Okay. The question now is, what can we say now? If they ask you for, okay, what is the entity's cost of capital now? Are we going to be saying that the entity cost of capital equity is 10%? No. If we want to raise money now, what is the cost that we are going to be incurring? What we do is that we put all the total interest together, all the total return together. So what is the return that we are paying? Okay, the total return on equity, debts, and preference shares is 25,000. Okay. What is the total amount that we are paying this on? So we are paying this 25,000, which is the return from the three sources. And the money that we are taking from the three sources is this. Okay, so equity can be like 200,000 and we are paying some amount on it. So this 25,000, we are paying it on total capital that we are taking. So if the total capital that we are taking is 250,000, okay, we are just asking ourselves, okay, how much? This is the total money that we are taking from equity, debt, and preference shares, and the total interest that we are paying is 25,000. So we are just asking ourselves, what percentage of the total money that we are taking that will give us the total interest that we are paying? That's what we call the WACC. So the total interest over the total capital that we have taken. So we are paying interest of 25,000 on 250,000. What portion of the 250,000 that we are paying as 25,000? That's what we call the weighted average cost of capital. And this will be calculated like this for you. Okay. Basically, you'll be using debt and equity. So you'll be calculating your weighted average cost of capital like this. So we have the WACC is equal to, so we have the value of equity, which can be given in terms of percentage. Okay. Those are doing financial management, we know how to calculate the value of equity. So we have the value of equity, okay, value of equity multiplied by the cost of equity, then into bracket plus the value of debt by the value of equity plus the value of debt multiplied by the cost of debt 1 minus t. If the debt is what? If the cost of debt given to you is pre-tax, we find after tax because debt is tax deductible. So I'll prove this formula for you. Okay. Let me come here. Let's assume our equity. Okay. Our equity value, the value of equity is 50,000. Okay. And our cost of capital is 10%. What it means that we are paying 10% on equity. Our debt value, we are taking 30,000 and we are paying 5% interest on it. Okay. What is the cost on the what? What is the cost on the equity? The cost of equity, we are looking for the amount that we are paying on the equity. What is the value of the equity? What is the return on the equity? Would that give us 0.1 multiplied by 50,000?
5,000.
Okay, that will give us 5,000. What is the What is the return on the debt? 0.05
3,000.
multiplied by, is it
Oh,
3,000?
1,500, I think.
Okay. So that will give us 1,500. What is the total amount that we are paying? What is the total return?
6,500.
Okay. This 6,500. How much are we paying the 6,500 on? Are we paying it on 80,000? The 6,500. Are we paying it on the total amount of 80,000? We have taken 80,000 and we are paying
Yes.
6,500. So we now ask
Yeah.
ourselves, what portion of the 80,000 that we are paying as this figure? This is what we call, so this will give you a work. So let me now break this one down. Okay, we can write the work like this. Okay, we can write the work like this as what? As 0 points. So write 0.1 multiplied by 0.1 multiplied by 50,000 divided by 80,000. Okay, plus 0.05 multiplied by 30,000 divided by 80,000. Do you agree what we have over here can be written like this one?
Yes, please.
Yeah.
Okay. Okay. So we will now have, what is the 0.1 is the cost of what? The equity. So you can say this is similar to the cost of equity multiplied by the value of equity, which is the 50,000. You can see how are we getting 80,000? Is 50 plus what? 50 plus 30. So we
30.
now have the value of this one multiplied by this figure. Okay. We can also say this is the same as the cost of debt. Okay, this should be after tax cost of debt. So we are having the 1 minus T over here because if the cost of debt is pre-tax given to you, it's before tax, then it means that you have to find after tax. How do we find after tax? If the tax rate is 25%, after tax will be 75%. You multiply your cost of debt by what? 75%. So this will be multiplied by the value of debt divided by the VE plus VG. Okay, this is what we have. Most of the times they will not give you the value. They can give you, the capital structure in terms of what? Proportion. So they can say this is 5:3. So they can change the 50 and this one will tell you that it's 5:3. You use the 5 as equity, they'll give you. They can say the the ratio of equity to debt or debt to equity, they'll give you ratio, or they can give you percentages. They can say this is 50%. They can say this is what? 40%. It doesn't change the facts. If you come here, your value of equity will be 60%, and the cost of equity they will give it to you, your net will now be 40%. They are telling you that if you strike the proportion, the 80,000, okay, equity will give you like 60%. This will give you like 40%. So you can use percentages. The same way you can also use proportions. They can give a proportions. Okay, so that is not an issue. Let's see if we can do 3 questions on one. Or we do one on Thursday and look at transfer pricing. Okay, so let's do one. Let's do one. Let's do one. Let's do one or two. Okay, we have to solve 2 questions on this one. So we have examined it twice, so maybe anything can happen. So why yeah. So I have to pick a complex one. Okay, let me see. Okay. Okay, so let's pick the 14. Someone should read the 14 to us.
Okay.
Yeah, I see them.
The Links Engineering is listed company manufacturing pumps and valves for use in the irrigation sector. These highly engineered components are integrated into plants and equipment. The company has grown significantly via acquisitions in the last 20 years, become a worldwide business. The overall objective of the company is to deliver sustainable growth in value to the shareholders by working in partnership with customers to deliver innovative and value for money solutions, utilizing the skills of the highly trained workforce. The chief executive officer has reorganized that the company has been so focused on making acquisitions to the detriment of establishing sound management practice. The CEO has therefore tasked you to assess the link's performance using economic value added. So please, if you can scroll up so I read there. Okay. Additional information. Capital employed at the end of 2020 amounted to 350 million. DE had non-capitalized leases valued at 16 million in each of the years 2020 to 2022. Ignore amortization calculations. DE's pre-tax cost of debt was estimated to be 9% in 2021 and 10% in 2022. DE's cost of equity was estimated to be 15% in 2021 and 17% in 2022. The target capital structure is 70% equity and 30% debt. The rate of taxation is 30% in both 2021 and 2022. Economic depreciation amounted to 64 million in 2021 and 72 million in 2022. These amounts are equal to depreciation used for tax purposes and depreciation charged in the income statement. Interest payable amount to 6 million in 2021 and 8 million in 2022. Other non-cash expenses amounted to 20 million per year in both 2021 and 2022 required. Estimate the economic value added for the Links Engineering for both 2021 and 2022 and comment on the company's performance. B. State 3 advantages and 2 disadvantages of EVA. C. Explain the relationship between EVA and the present value and net present value. Yeah.
Okay. So this one, I will do the A part. The advantage and disadvantage is in the lecture note. You copy that one. Explain the relationship between the economic value, this one and this one. They are all done in what? They are all done in cash flows. Okay. They are all done in cash flows. They all take into consideration cash flows. So we need to know we do it for 2021 and 2022. So we are doing it for the 2 years. Okay. This is what we do. Okay. So you now come here. We need to know our no parts. We need to know our no parts, which is the economic value added was tax before economic net operating profits before interest by after tax and also economic capital employed. Very simple situation here. Let's come here. So okay. So I'll come here. I'll do my no parts. I'll do the adjustment for the no parts. Mostly we start with the accounting profits. So I'll have 2021 here and I'll have 2022 here. So let's have the 2 years over here. Let's have the 2 years over here. So we start with the accounting profits. Okay. So just write profits after tax here. So we start with profit after tax, accounting profits, okay, after tax. Let's come to this situation. What is the profit after tax for 2021 and 2022?
2021 is 71 and 2022 is 88.
88.
Okay, so we have 71, 71, and 88. What are we going to be adding? Non-cash items will come. Do you agree?
Yes, sir.
Okay. Non-cash items will be provision for doubtful debt, provision for uh, provision for deferred tax. It can also be the impairments and all those issues. So we go and pick non-cash items. We are looking for cash profits. So non-cash item that has been taken away from the what? From the profit to be added. Because the difference between cash flow and the what? Profit is the non-cash items. So what is the non-cash? Other non-cash expenses amounted to 20 million per year in both year 2021 and 2022. So that will now be 2020. Do you agree? So I'll do 2020 over here. Is that correct? Okay. Interest has been taken away, and the interest we mostly do after tax interest. Please, are we together? Are we together?
Yeah, senior.
Okay. Okay, let's move on. So what is the tax rate given to us?
30%.
30%.
What is the interest? What is the total interest for each of the years? 6 million and what?
8 million.
And 8 million. So if we are paying tax of 30%, what is the remaining percent that we will not pay tax on?
70%.
Okay, so you find 70% of these figures. So 70% of 6 and 70% of 8. So we now have, this will be after tax. So you do after tax now. Okay, so you do after tax. You can multiply somewhere and bring the figure. That is not a problem. So 70% of 6 million is how much? And 70% of 8 million is how much?
6 million is 4.2 and 8 million is 5.6.
Okay, 4.2. The interest has been taken away from our profits. The interest has been taken away from our profits. Okay, but the interest is part of what? It's part of the imputed cost already. But the interest over here will be after tax interest because we are using after tax cost of debts. So the interest that should be in the profit so that we can take the one that is in the imputed cost will be after tax interest. After tax interest. In most cases, the interest is captured in the what? In the cost of capital. So we now have 4.2 here and how much here?
5.6.
Okay, 5.6. Okay, let's come here. Do you have any issue about investments in intangible assets? Do you have any information about investment in intangible assets here? No. Do you have any information about accounting depreciation being different from economic depreciation here? Do you have any information about accounting depreciation being different from economic depreciation? Economic depreciation amounted to 64 million in 2021 and 72 million in 2022. These amounts were equal to the depreciation used for tax purposes and depreciation charged in the income statement. Okay. What it means is that if you go and subtract, the accounting depreciation is the same as 64 and the same as well. Accounting depreciation for 2021 is the same as 64. 2022 is the same as 72. If you go and subtract accounting depreciation or if you go and add it, it was subtracted. If you go and add 64, you will still subtract 64 as the economic depreciation. So it's going to be having a zero effect. So we use economic depreciation instead of what? Accounting depreciation. But since the two are the same, it means that you'll be having the same effect. You add 64 as accounting depreciation, then you still subtract 64 as economic depreciation. So we ignore that one. Okay, we ignore that one. If they are the same, you ignore. But if they are not the same, then you add back to accounting depreciation. Then you subtract your what? Your economic depreciation. But in this case, they are the same. Do you have any other item that is going to be affecting the profits? Do you have any other item that will be having effect on the profits? We have the non-cash item that has been subtracted, we add it back. The interest has been subtracted, we add it back. Do you have any other item that will be affecting that? Do you have any other item? No.
No.
Okay. So for the information that we have, there's no other item. So this will be what will be the no part for the two.
95.3 for the first one.
Okay. The first one is
And the second
90.
5.3.
Okay. And the second one is
113.6.
113.6. Let's have the capital employed. Okay. So the capital employed, we have the opening figure. Okay. Opening capital employed. Okay. Let's have the capital employed then. 2021. Which year are we going to be using for 2021?
2020.
That of 2020.
2020.
So we use 2020, isn't it?
Yes, sir.
And we use 2020. So we have 2020 here. 2022, which year are we going to be using?
2021.
Okay. We use 2021. Can we determine the 2021 in the statement given to us? You always start with the book value. And the statement, from the statement given to us, can we determine the capital employed for? What is the capital employed? 2021.
400.
That's 400. Okay. That's 400. So you have the shareholders fund plus medium and long-term bank loans. That is 400. Okay. So this is non-current asset plus net current asset. It means that they have already taken the liabilities. So we have 400 there. Oh, sorry. This is supposed to be. Okay. So you have 400. Would this be 380?
350.
Yes.
350.
350.
Okay, you have 350. What will be increasing this one? Now capitalize what?
Lease.
Okay.
Bunker.
Uncapitalized lease. So the lease will be happening throughout the year. Okay, so that will also be captured. It's not happening at the end. We are not. If you are taking the lease at the end, it means that the lease, you have not used the asset for the year, so you cannot pay interest for that particular year. So that will not be captured. The lease is assumed to be taken during the year, which you are going to be paying interest on it. Okay, so let's come to the lease. Are they giving us information about the lease for 2020 and other years? We have
60 and 12.
60 million in each of the years 2020 to 2022. So it means that it will affect the what? The 2021 figure and the 2022 figure, isn't it?
Yes.
Okay. So this one will come to 16 and will come to 16. Okay. The 2020 will be captured in 2020. So the lease is happening during the year. So 2021 will be captured. What do you think will be another item that will be captured over here? But if you check this is a past question. But if you check it, they have not captured it. Okay. But you have to capture another item here. Would the economic depreciation be having any effects on these figures? No. Because the economic depreciation is the same as what? The accounting depreciation. So the depreciation has been taken from 64 has been taken from 2021 capital employed. Okay, so that should be added, but it should have taken economic depreciation of 64. So that is having a zero effect. But let's come here. Other non-cash expenses amounted to what? 20 million per year in both what? In both 2021 and 2022. What will be the effects of the non-cash item? Assuming the non-cash item is provisioning for doubtful debt, what is the effect? What is the effect on the capital employed in 2021? If it is provision for doubtful debts, what is the effect What is the effect it's having on the current assets? 2021. What is the effect it's having on the current assets in 2021?
It's reducing it.
It's reducing it.
It
Okay,
has
but
reduced.
that's a non-cash item. So if you come here, you have non-cash item, non-cash item. There was none for 2020, so that will not come here. But in 2022, you come and add this over here. Because in 2021, the capital employed should have been 400 plus 20. Okay, the capital employed should have been 400 plus 20. Why 400 plus 20? Because we have taken a non-cash item of 20 from our current asset. We are looking for economic capital employed, cash value of the capital employed, not accounting capital employed. So this 20 has been taken away from the current asset. If it is what? If the if non-cash items is provision for doubtful debt, it means that it has reduced our what? Our current asset by 20. So if we should have prepared our financial statement based on economic basis, these 20 would not have been subtracted from our current asset. So capital employed would have been 420. So that's why we are adding the 20 back. Okay. But in the solution, they have ignored it. I don't know whether they think whether the capital and non-cash item, since it has not been specified, it can be provision for doubtful debts, it can be provision for deferred tax, which is going to be reducing our capital employed. I don't know. But whenever they give you non-cash items, please, it is going to be affecting the capital employed for the subsequent year. Okay, it has reduced the capital employed for 2021. We are now using the capital employed for 2022. So if we should have been preparing our statement of financial position on an economic basis, the non-cash items of 20 would not have been taken away from what? From the current asset. So the current asset should have been added value, 20 added to the current value that we are having now. So it means that the capital employed that we are having at the end of 2021 it has been understated by 20. So if you go to the next year, you have to now use the actual capital employed in terms of what cash economic value. So that's why we are going to be adding the 20 here. But they have ignored the 20. The reason, I don't know, maybe since the non-cash item has not been specified, anything that it can be provision for doubtful debt, which is going to be having a negative effect, or it can be anyone. But if you are giving non-cash item, please, it should be having effect on non-cash item for this year. It will be having effect on the capital employed that you are going to be using in the following year. So that will be increasing it. Okay, it has reduced it. So it has been taken away from our capital employed. So you go and add it back to have the economic one. So I'll be having 366 over here. So having 366. Okay. Then I'll be having what we got? 436. Okay. So please, the operating list for each year should be added because the list will happen during the year, which you pay interest on it. So that will be added to the opening figures. Okay. Let's come to the EVA now. So the EVA, we calculate it now for 2021, then 2022. 2022. So I'll have this figure. I'll have this figure again. Okay. So if I have this figure, then this is what I will do. I will have the EVA now. Okay. So I have my new parts. I'll have my new part of 95.2. And I'll have my 113.6 here. Then I'll come to my imputed cost here. The imputed cost, we have to calculate the weighted average cost of capital now. Very simple one. So let's come here. They have given you the target one. They are giving you the target capital structure now. The target capital structure is what? 7% of equity and 30% of debt for both years. The pre-tax cost of debt was estimated to be 9% in 2021 and 10% in 2022. The cost of equity was estimated to be 15 in 2021 and 17 in 2022. These are all different what? Different figures. So we calculate true cost of capital. So you do 2021 here. We have our equity to be 70%, or you can do 0.7. Okay, or let's do 70% rather. So you do 70 multiply by the cost of equity. What is the cost of equity for 2021? Is that 15%?
15%.
Okay. So we have that of 15%. So I have 70 multiplied by, so I have 15% here divided by, would this be 100? Do you agree to be 100? 70 plus 30.
Yes.
Yes, sir.
So we have plus, this will be 30. Okay, this will be 30. Then multiply by, what is the cost of debt for 2021? We are giving you pre-tax. So you find after tax. Okay. So pre-tax is 9%. Is that 9%? Okay. So that is 9%. We have 9% now into bracket 0.7. Do you agree?
Yes, sir.
After tax is 70%, which is 0.7. So what are we having? Please just do it on the calculator and give us the phone number.
12.39%.
Okay, 12.39%. So your cost of capital, your imputed cost over here will be 12.39% multiplied by the capital employed. Let's do that one and get the answer there. So this will be 0.1239 multiplied by 366 for the first one. Okay. Then let's go and do the work for 2022 now. Work for 2022. So work for 2022 will be the same capital structure, 70 multiplied by, I'm sure that is 17% divided by 100, 30 multiplied by, let's check the cost of capital for that year. The cost of capital for that year is 10%, 2022 is 10%. That is pre-tax. So I have the 10% now, which is bracket 0.7 divided by 100. Corner answer.
14%.
14%. So we come here and do 0.14 multiplied by the capital employed. So the same thing that we are doing, that it is different from the residual income. Residual income, we are using accounting profits. You can see the same thing, but we want to know the value added in terms of cash. Okay, so what is the value that we are having? 0.1239 multiplied by 366. What are we having?
45.35.
So 45.35. Okay. What about the 2022? 0.14 multiplied by 436.
61.04.
We have 61.04. Okay. So what is the figures now? What is the EVA?
49.8.
4.
49.85.
Okay. 0.85. Okay.
52.56.
652.
52.56.
Okay. So they say you should comment. The comment is very simple. In 2021, the managers of the company or the directors of the company has added additional value of 49.85 million to the value of the shareholders. And in 2022, they have added what? 52.56 to the value of the what? Of the shareholders. So the actual value that has been added, the actual additional value that has been added to the worth of the what? The shareholders or the owners in 2021 is 49.85 and 52.56. more value has been added in 2022 than what 2021, or they have added additional value. So you can find a difference here. Additional value has been added in 2022 than what than 2021. That is it. The advantages and the disadvantages is in the lecture notes. Okay. Someone can say the work is what is might be difficult to understand because look at the adjustment that we have done. I have another question where you do the adjustment, you try that one. At least we have to finish the EV now and do the transfer pricing on Thursday. Then we can now move on to public sector in the West management accounting in the public sector. Okay. So look at the advantages here. Where are you? 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 Okay. These are the benefits over here. So these are the benefits and these are the limitations also. Okay. So you can look at them. Okay. That is not the let me go down. Let me go down. Down. Okay. Let me check this down. No, this one, this question about 15. I'll give it to you. Then let me check 15. 15, you will do that one yourself. Okay. So I want to be like other people that will give you difficult question and they will solve small one with you and give you difficult question. Okay. So let's come to hey, I'm sure I have one. Okay, it is the same one that okay, I've added figures. Okay, so we now adjust that one again. We will still it's the same one, but we have added plenty things now. So we will still no, I want the one that economic depreciation. Okay, so our adjustments. Okay, the same question. I've added figures to it. So this will now help us to This will now help us to adjust everything very simple now. Okay, so the capital employed for this one is this one. The tier had non-capitalized is of this one is still the same. The pre-tax cost of debt is 9%. The cost of equity was estimated to be 15% in 2021 and 17% in 2022. The same thing. The target capital structure is this one. The rate of taxation in both years is this. Economic depreciation amounted to 64 in 2021 and 722 in this one. So this one I should have added uh, accounting depreciation. These amounts were equal to the depreciation used for tax purposes. Okay. Then we have interest, interest, interest payable amount to 6 million in 2021, 8 million. We have done that now. Okay. Other non-cash expenses, bad debt provisions, etc., amounted to 20 million per year in both 2021 and 2022. We have done that. Let's look at the two, how you are going to be adjusting the two. Okay, although I'm looking for a situation where they can give us, I want to, the economic benefits, the economic depreciation should have been different from the accounting depreciation. Then we add it and subtract. The same adjustment will be done for uh, the capital employed also. Okay, let's come here. I'm sure something will happen. So the same thing that we are doing, but let me add additional one here. Let me add additional one here. Please, we are going to be making some, we are going to be making, I'll do adjustments here to the economic depreciation. Okay. We are going to be assuming that, our accounting depreciation for 2021 was 60 million and it was 80 million in 2022. We are going to be doing that assumption. Then I'll treat how that should be done. Okay. So we'll be having the same thing. We'll be copying the same thing like this. The same notepad, we copy the same notepad like that. So I have question number what? I'll copy the notepad and the same thing like that. 2023. Question number 20, question number 23. I'll copy the same notepad like that. So I have the new parts. I have the 2021 and I have 2022. Okay. So I'll come here, I'll have the middle. So I'll adjust this one for you now. Okay. So let's come to this one. We now have the profit after tax. Okay. The profit after tax will now be 71 and 88. We have the non-cash items. We have the non-cash items. So the non-cash items. Oh, we have the non-cash items to be 20, 20, 20. So I have the interest after tax interest. Okay. And that's why next year I'll be having 4.2, 4.2, and 5.6. Okay. So the same thing, but we are coming to adjust the last two now, the impact of the last two. Okay. So I'm saying this one. I'm saying that we assume that the economic depreciation, the economic depreciation for 2021, the economic depreciation was 64, but the accounting depreciation was 60. Okay. We will now come here and say that 2022, the accounting depreciation was 80 million. Okay. Which of the depreciation was used to what? To determine the profit that we are adjusting? Which of the? It was
The
what?
accounting depreciation.
Okay. But which one do we have to subtract? If you want to determine no part, which of the depreciation are we subtracting?
The economic
The
depreciation.
economic one.
Okay. So you can see that we have what? We have subtracted what? We have subtracted only 60 out of instead of 64. Do you agree?
Yeah.
Yes, sir.
Okay. So I'll come here. I'll add. Should we subtract only 4, or I should add the accounting one and subtract the economic one? Which of them do you want?
So add and subtract.
Yeah, add and subtract.
So we have the accounting one, accounting depreciation to be. So that was taken from our profits. This was 60. And this we are having 80 for this one. We assume this one is 80, isn't it?
Yeah.
Okay. So we now take the economic depreciation of 64, and we now take this one of 72. Do you agree?
Yeah.
Yes,
Do you
sir.
know this? Do you know this will have this 2021 will have effect on our capital employed? I hope you agree. We should have taken 64, but we have taken 60. It means our capital employed has been overstated by 4. The capital employed for 2021, we have taken non-current assets, we have taken 60 because the statements we have prepared based on what? Accounting purposes, or based on accounting information, not economic information. So the non-current asset that we have, the depreciation taken from that was 60. But for economic purposes, it should have been 64. So we have to go there and take what? And take the 64, or we go and add and subtract again. We do the same thing over there. But the 2022 will be used for 2023. So that will be, if we have 2020, then 2020 will be coming 2021. So this will be affecting only this particular one. So let's go now, and I will talk about this one now. Included in taxation amount for 2021 and 2022 are tax cash paid of 32 million and 40 million in respect of both years. Let's go to the tax now. Let's go to the tax. What are the tax figures? What are the tax figures? 2021 is how much?
46.
No,
36
2021.
million. Sorry, 37.
Okay. 2021 is 37. What is the cash paid? What is the cash tax paid? What is the tax that what is the actual tax that has been paid?
32.
32.
32. But how much are we having there? 37, isn't it?
Yeah.
Okay. Those of us who did financial reporting, okay, deferred tax adjustments are added to current tax, isn't it?
Yes, please.
Okay. The actual tax that we are paying on a profit, the actual tax that we are paying, Okay, I've said that we always use the tax paid. We use the tax paid, cash tax paid. Okay, so the actual tax that has been paid is 32, but we are reporting 37. What it means is that increase in deferred tax provision, increase in deferred tax provision of 5 million has been added. The deferred tax is a non-cash item. We are not paying, so you have to reverse that one. So we have taken 37 instead of 32. So you have to go there and add the 5 million back. If it is increased, that is a decrease in deferred tax. So we go and subtract. Okay, so maybe the actual tax might be 40, but there's a decrease in deferred tax of 3. That is why we are having 37. So we go and adjust that one too. So I'll read the remaining portion of it. Then you look at it. The deferred tax is a non-cash item. We use cash paid, actual cash paid. So what is a cash? What is a tax cash paid? That's what we are looking for. Okay. In respect of both years, the difference should be treated as an adjustment for deferred tax provisions. There was no deferred tax balance prior to 2021. So it means that deferred tax is arising in what? In 2021. You have to know that deferred tax will also affect our capital employed. Don't worry, we'll get there for 2022. 2021 figure that will be using for 2022. That will be affected. Okay, so we come here, we now adjust this figure. Okay, you can see that the deferred tax is reducing our profit. Do you agree? Deferred tax is reducing. Okay, deferred tax provision is reducing our profit. So we add 5 back here. And how much are we adding back for 2022? 2022, the actual tax paid is 40. But what is the figure that we are having there? 46.
46.
So we add 6 back. Okay. We now add the
Yeah.
6 back. Okay. So this will be treated in the capital employed. Thank you. We are going to be adjusting this question now. So this will open your mind to be more on the adjustments. Research and development expenditure of 10 million is not capitalized in the accounts. It's related to a new project that will be developed over 5 years and expected to be of long-term benefit to the company. 2021 is the first year of this project. Okay. So they are saying that this has not been capitalized. What it means is that it has been expensed, isn't it?
Yeah.
Okay. I said 2021 is the first year of what? This project. So what will happen? If the project will be for 5 years, what would have been the value that will be taken to profit or loss in 2021?
2 million.
It should be 2 million, isn't it?
Yes, sir.
Yeah.
Okay. So what we do is I'll do the 2. We reverse it. We can decide to add 8 million back, but we reverse the transaction back. This happened in 2021. So we come here and have research and development expenditure. So research and development, we reverse the full amount. Okay. So reverse the 10 million. This will be dash. Then we now bring amortization here. Amortization of 10 divided by 5. This will be 2 million. So amortization should be taken. Do you agree that amortization will affect 2022 also?
Yes, sir.
Yes.
The 10 million will now be spread over what? Over the 10 million will now be spread over the 5 years. So every year 2 million, 2 million, 2 million. Okay, that is the cost that we are spreading. Okay, so let's now calculate our no parts now. Let's calculate our new no parts. Then I will now do the capital employed for you neatly now. Capital employed. So we now have 2021, then we have 2022. So I have the net book value at the beginning, which is the beginning figures. This will be 350 and this will be 400. Okay, then we now have non-capitalized leases, okay, which I will just write operating leases here. Okay, operating leases was 1616. Okay, let's now take our time to do the things that's supposed to be done. Yeah, we are using 2021, so non-cash items will not affect the 2021. Okay, non-cash items of 20 will be added here. Do you agree to that one? We have done that one already. Okay, So we have done the non-cash item for this one. Let me now take the issue of depreciation, the fair tax, and also the research and development expenditure. Okay, let's come to these statements. Let's come to these statements now. Okay. Included in the tax amount for 2021 are tax paid, and this is going to be our tax cash paid of 32 million and 40 million in respect of both years. The difference should be treated as adjustment for deferred tax provisions. Okay, this one should be treated as adjustment for deferred tax provisions. There was no deferred tax balance prior to 2021. So the deferred tax that is arising from for 2021 is what, 5 million, isn't it?
Yes.
Deferred tax arising in this one. This will be shown as what? Non-current liability.
Current liability.
Okay. Which has been captured in our capital employed. Do you agree? It has been captured in our capital employed over here. Looking at the accounting information given to us, it has been captured in our capital employed. You can see that the capital employed, they are saying that non-current asset plus what?
Yes.
Net current asset. It means that it has been captured for 2021. Okay. Should the deferred tax provision be part of the capital employed? Should deferred tax be part of the capital employed?
No.
No. But which year was it captured? That would be 2021, isn't it?
Yeah.
Okay. So it means that included in this figure, there is the deferred tax 5 million included. Okay.
Yeah.
So this figure will now be used for 2022. So what do we do?
We add it back.
No, it is already there. It is not treated as current liability. It is treated as non-current. So it is part of that one. So we have to take it. Okay. So it is no addition. That will be taken. So we now come and subtract the 5 million. The deferred tax is included as part of the capital employed, the non-current liability, which is capital employed is non-current liabilities plus what? Plus the shareholders fund. So the deferred tax of 5 million is there. Is part of the 2021 figure. And 2021 figure, we are using it for what? 2022. So the deferred tax should not be part of the 400 million. So we are taking the 5 million. We are taking the 5 million. Okay. We are taking the 5 million. Let me come to this one. I will come to the research and development expenditure before we now come to. So I'll come to the research and development expenditure before we now come to the depreciation. Okay, you pay attention to the issue on depreciation, research and development expenditure. Okay, at the end of, if we are preparing the statement of financial position based on economic basis, at the end of 2021, we should have had what? Research and development expenditure as part of the non-current asset, which will be 8 million. Do you agree?
Yes, senior.
Yes. Yeah.
Okay. We should have had research and development expenditure as part of this figure as 8 million. Okay. Because we have amortized one. It is done on the 2021. So we have used 1 year, remaining 4 years. So this will have been part of our non-current asset at 8 million. But is it part of the capital employed that we are using for 2022?
No,
So what do we do?
we add it back.
You add it back.
So this will be added to, it will not affect 2021. 2021, we are using 2020 balance. So this will come here, we add it back. So this will be having effect over here. Let's come to this figure. Let's come to the issue of depreciation. Okay. What was the depreciation subtracted from 2021 figure? Accounting depreciation that was subtracted was how much?
60.
Accounting depreciation that was subtracted from 2021 figure. Accounting depreciation that was subtracted here. Okay, we have made some adjustments here. The depreciation that was subtracted here was what? 60 million. Do you agree?
Yeah.
Okay. But how much should have been subtracted?
64.
64.
Okay. So this is what you do. You add the accounting depreciation back. Okay. The depreciation will be having effects from all the non-cash items, okay, all those transactions apart from the operating leases, all of them will be having effects on the subsequent. If they happen in the previous year, they'll be having effect on the subsequent years because all of them have been taken away from the closing balances. So it will not have effect in the year that they happen because we are using the previous year own for this one. So this happened during the year, it will not have effect. It will have effect on the following year. So we come here, we come and add the 60 back. Okay. Then we now come and subtract the economic depreciation. We should have subtract 64. Okay. So we now come and subtract the 64 rather. So we come and subtract the 64 here. But I'll make this one as net effect now. So I'll just write additional depreciation. So I'll just write additional depreciation here. So I have additional depreciation here. So research and development expenditure. Write additional depreciation here. Write additional depreciation here. And that will be 4 million as a subtraction. Do you agree? We subtracted 60
Yes, sir.
instead of 60. So we have 366 now. Then with this figure will give us what?
Senior, I want to ask about the amortization. It is also
Okay.
a non-cash.
No, the amortization is not non-cash. It is a 10 million that we have what? That we have spent, that we are spreading. So every year we are using it to generate cash. So we should be taking the 2 million from it. So what is a portion of the 10 million that has been used to what? To generate cash. So we match it. We are doing it for matching principle. Okay. So it is same as it is same as we call it. Okay, let me just name it economic amortization. Okay, so it's the same as the economic amortization, which is the same as the economic depreciation. So what portion of the amount has been used, okay, to generate that one? We do that one in economic terms. Okay, the depreciation that we are using because the accountants are calculating that one. That's why we are not accepting that one. We calculate the depreciation based on the usage, based on the benefits that the asset has generated. That's how we go about it. Okay. So the amortization is allowed. It's being seen as economic amortization instead of accounting amortization. Is that fine now?
Yes, senior.
Okay. So please, you can add now and you calculate your economic one. So your weighted average cost of capital will still be the same for the two. Then you just calculate this one, you multiply and you calculate EVA. We have solved 2 questions in 1 question. Okay. Any other issue? We will be taking which one? We'll be taking okay. So we'll be taking transfer pricing and some other questions on Thursday. Okay. So question number. So you can try the rest. I have plenty questions there. So I'll send you some. 9, 10, 11, 12. Okay. So please, if there are no issues, I'll see you guys on Thursday. Please, my assignment, don't forget. Okay. It's supposed to maybe Thursday or something. So please, if you don't submit, I'll have issues with you. The group, I'll have issue with the group. I can even take your name to IGP or maybe somebody to take action against you. Okay. Because you cannot be paying me and you say you don't want to pass. Who does that? Okay. So I'll have issue with you. Thank you for coming. I'll see you guys on Thursday.